Not been so good for global equities. The Indian markets are down close to about 5.5%. Look to the US markets, the Dow has lost nearly 4% up until now in 2015. And even in the Asian markets, the picture has not been that much better, with the likes of Hang Seng losing close to about 7.5%. So the question we're all asking now is, how is 2016 going to be? And while everyone may not have the answer for us, we're now joined by Fredrik Nerbrand, the Global Head of Asset Allocation at HSBC Bank. And he's done some very interesting analysis about the top 10 risks that we need to watch out for in 2016. Hi, Fredrik. Thanks for joining in. In the 10 risks that you've outlined, you've classified them as the good, the bad, and the ugly. Take us through the key findings.
So, first of all, when we think about the risk for 2016, I think it's important to realize that we are presumably at the latter stages of the business cycle expansion. So from that perspective, most of the risks that we've got here are on the downside rather than on the upside. We only have two upside risks, and then we have a series of bad and then two ugly risks that are both US related. So what we tried to do in this report is to kind of classify some of the issues that the world faces, or the global economy and markets faces in 2016, and then to ensure that we prepare and think about what happens during each one of those scenarios. But I should stress, none of these are base cases. These are merely an exercise in intellectual rigor to ensure that we're prepared for any eventuality where any of one of these risks do indeed materialize.
All right, Fredrik, the worst risk for 2016 is if the Fed will go ahead and tighten rates aggressively. Now, the dot plot suggests that 4 rate hikes are in the offing. What constitutes aggressive hikes, and how bad can it get for emerging markets?
So, I mean, it's important to stress that we only really believe that the Fed is going to hike twice in 2016. But if the Fed were to hike more aggressively on the back of more potent inflationary concerns during the course of the year, that would essentially become a policy error. So that if the base effects from lower oil prices as they start to fall away, and commodity prices, etc., all of those base effects as they fall away, inflation picks up, the Fed tightens in line with their dot plot, all of a sudden the market is mispriced, and then all of the assets pretty much, we do believe, is more of an asset depreciation story rather than one which has been an asset appreciation story that we've had over the last few years.
Okay, since our audience is largely Indians, from an India point of view, what would be the key risks that you'd watch out for next year?
Well, I think that it's some of these risks would indeed be global. So we've picked these risks to have out of a number of risks that we highlighted when we did this report, and picked out the 10 that were most relevant from a global audience, and that some of them would have an implication for Indian investors as much that they would have anywhere else. I mean, for example, if we would see that dot plot, a Fed policy error, that would have significant impact on India, as would a much higher oil price, or for that matter, a US recession. It's interesting if we look at one of the risks that we've highlighted, which is an increase in Chinese corporate defaults. If that would start to unravel, and the Chinese policymakers were forced to then depreciate the currency somewhat, or allow it to have more flexibility on the downside, that would to some extent benefit Chinese producers over, for example, what you would see in other Asian markets, India included.
All right, Fredrik, then what's HSBC base case expectation of India's performance in 2016?
So we have a fairly positive view on India. In our asset allocation process, India is actually one of the emerging market currencies that we prefer to get exposure towards. When we're looking at India from a global perspective, it is more geared towards, we believe, is going to be upside from a total return perspective, sitting in Indian bonds than to sit in Indian equities. India is, to a large extent, from a global perspective, the poster child for a good emerging market outlook compared to some of the other emerging markets. So when we're looking at emerging markets as a whole, especially in bond markets, Indian Indian bonds, specifically the 10-year spectrum, we find particularly valuable.
Okay, Fredrik, thanks so much for taking the time out. So that is HSBC's analysis of some of the big risks that we could face potentially in 2016. And the worst one could be if the Fed were to tighten aggressively. By the way,